Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for the channel and all the comments and subscribers. I greatly appreciate it. This channel is dedicated to the cash flow hungry, rational investor who buys cash flowing businesses, holds them for a long time, and make excess returns above the market. That's the goal. We're going to take a look at PayPal, look at how much cash money it generates, what we believe in the next 10 years, how much cash flow this business is going to generate, and then if we buy it now, how much would we earn over the lifetime of that investment? That's what we're going to do here. And we're going to use the 10K behind me. I got an Excel model we're going to roll through. You ready? Let's get to work. Before we dive into PayPal, let's cover the 5 key attributes that we use to evaluate each stock here at this channel. Number 1, top line revenue growth. We want to see top line revenue growing. Number 2, earnings. We look at EBITDA, enterprise level earnings. We need that to be growing. Strong free cash flow, that is a must. Low debt, and a well-priced stock. Well-priced is something to the eye of the beholder. You can go dumpster diving for the cheapest of the cheap, but generally they don't have any growth. You can pay up as a premium for a company that is a rocket ship, that is growing, but most of the time, if it's really popular, all the growth is baked into the price. So you kind of need a balancing act, and that's why I say well-priced and not a particular metric. Because we want something that is reasonably priced. The odds of us getting it super cheap are very low. But we want something that, in essence, will generate an above market return for us over the 10-year period of time that we use. We use enterprise value to EBITDA as our benchmark. Okay, let's dive right into the 10K behind me, their annual report. This is 2020's annual report. There's a new report coming out in 2021. Their fiscal year is December, and I highly recommend that every year you read the report if you're an investor or prospective investor. It has fantastic information in it. It's not salesy, and it really gives you the black and white picture of how much cash flow this business generates without the pomp and circumstance around various other media folks, the investor relations department themselves within the company. Management can also be very, very salesy and make promises that they can't deliver on. But reading the 10K or the annual report, and especially going back and reading old reports and looking to see how they actually performed against what they said they were going to do in the past, is an excellent way to judge management. So let's dive in quickly and go through a couple key things. All right, the first place I want to stop in the annual report is this one page that summarizes. I'm on page 12 if you're referencing. Here, you're seeing revenue, $25.1 billion is continuing to grow. Fantastic. They bring up non-GAAP operating margin, which is a proxy for kind of cash flow. We use EBITDA. They're using operating margin. Operating margin just has depreciation subtracted from it. So this is a lower on the P&L measure of profitability. Their margins are growing, which is fantastic. And I love that they bring up free cash flow on one of the very first slides when they're talking about the company. And that's a hallmark of a company that is focused on free cash flow generation. If they're bubbling free cash flow up to the top of the presentations, to the top of the annual reports, that means A, they have it, and B, they're focused on it. What you'll see from companies that don't have free cash flow is they will talk about revenue. Why? Because cash flow is negative, so they're not going to talk about that. They're talking about the bright point, which is revenue. If they don't have any revenue, they don't talk about total addressable market, TAM. It's kind of a scam the way they run it. There's no set formula for what they present and how they present it. So you basically can tell what's the focus of management based on what numbers they bring forward. And the closer they get to this number, cash flow, the more profitable they should be, and the more focused management is on the ultimate value of a company, which is this free cash flow. So I'm glad to see it's big and kind of growing. Next thing for valuing and forecasting PayPal, how do we do this? Well, down here, they say active accounts, 377 million accounts, and total payments processed, which is a critical number, almost $1 trillion, $936 billion. What I liked here is they're giving the number of customers here and the total volume of money moving through their system here. And what you're going to find, if you look at these two numbers over time, they are growing. And the cool part is the total value of money, the total transactions is growing faster than the active user account. What does that mean? That means that they're adding users and they're growing at a double-digit rate of user base, but then each user itself is using their service more and more. They're moving more money through the service because they're satisfied, presumably, or they're doing economic business. Even my channel here, I run payments through PayPal. So this is a great indicator of both customer satisfaction and gaining market share, which I really, really like. And I'll forecast the business based on these two and then translate these two into revenue and revenue into earnings. And we'll go through that in a second. But I wanted to walk through this. It's very, very big. Let's take a look at the cash flow and the income statement really quickly. All right, behind me is the balance sheet. Let's take a look at how do we read a balance sheet. We'll pick up with PayPal here. I've got 2020 December ending. So again, this is December 2021 when I'm filming this. So we're missing a year of data. I'll plug that in the forecast. I'll show you how to get that in a second. But I still want to smell check the actual physical document that they've released, the annual report, to get a feel for how they run their business. And you can see they have a tremendous, tremendous amount of cash. So cash and cash equivalents, 4.7, call it $5 billion of just cash money sitting in the bank account. And then on top of that, they've got $8.3 billion of short-term investments. Short-term investments, that's a balance sheet line item for basically treasury bonds or highly liquid, non-volatile assets that they will use because they have so much cash that their checking account is overflowing. They're like, okay, fine, I'll buy some, 2-year treasuries. No, these are short-term, less than a year. So 30-day treasuries, 6-month T-bills. They'll do that. They'll do very short-term investments because they have so much cash. You add this up, and it's $12 billion of free cash because they make so much money just piling up on the balance sheet. That's a great start when you're looking at a company. I'll add this cash back, by the way, or rather, I'll subtract it from the enterprise value because it is so excess that they don't even need to keep it in the checking account. And really, that cash should have been dividended out. They should use it to buy back shares, but they haven't. And if we were to buy PayPal at an acquisition, if Google were to come in and buy it, right, the investors who own PayPal today would say, hey, this is old money that I generated that was never kicked to me. Dividend this out to me before I sell the company to Google, hypothetically. That's how we look at excess cash. Anyways, total current assets, $50 billion, amazing. Total assets, actually very few hard assets. It's a software company, it makes sense. Current liabilities, $38 billion. So the Ben Grahams of the world are going to love this. You've got current assets greater than current liabilities, and actually greater than long-term liabilities. So this company has zero debt in it. So from a credit perspective, if you think of yourself in from a bankruptcy perspective, should something happen to PayPal and it goes bankrupt, you as an owner, as a stock owner, you're the last in line in bankruptcy court. But because there's no debt here, there's no one in front of you. So you essentially become a debt owner, but with returns like an equity owner, because there's no debt in front of you on a claim to the assets. So this cash that's up on the balance sheet, when the judge is saying, hey, you're bankrupt, not that you have this cash if you're bankrupt, but hypothetically, you had other assets. The judge is dispersing the assets in a liquidation sale. The first to be paid are any employees that you haven't paid, then the various current asset vendors, the merchants that do business like Staples or Cintas. All those vendors for businesses get paid first. After that, it's bondholders. Well, there are none, so then everything else goes right to the equity holder. So you're first in line to get the assets in a bankruptcy sale, which is a great position, but you have returns like an equity investor. That's fantastic. Statement of income. So income, 2018, 15 billion, 17 billion, 21 billion, growing, phenomenal. Transaction fees and operating expenses, 18, 15, 13. So here's the actual profit each year, the operating profit. That's what they referenced in there earlier with the margin of 25%. So operating profit's positive and growing. We'll create EBITDA off this, which is basically taking this number and adding depreciation amortization. I also pull out any of the share-based comp. I make sure we expense that. And then you've got total shares outstanding and earnings per share. Again, we don't look at earnings per share at this channel because this number here is manipulated by the by the denominator. If I'm a CFO by profession, if I'm running a business and I have an earnings target that I have to hit, an EPS earnings target, and I know roughly what this number is going to be when I'm getting a draft of my P&L, right? I can go ahead and buy back shares, this number here, and reduce the shares outstanding. So when I take this number divided by this number, I know what this number is. That's how companies will meet EPS year after year after year after year, because the CFO is saying, oh, I know approximately what this number is going to be. I know what the street expects this number to be, so I'll buy back some shares or I'll issue shares to set this number to equal that. And it's manipulatable. That's why I don't like it. Is that a word? Manipulatable? Anyways, you can manipulate it. What you can't manipulate is earnings per share. Operating income, or what we use is EBITDA. So when you go up on the P&L, it becomes harder and harder to manipulate the number. That's why we use it. Okay, that's income statement, very, very clean. And lastly is the cash flow statement. Cash flow statement begins with the net income, right? You have 3 sections to the cash flow statement. You've got the top section, which is operating income. How much cash money do they make running their business? $5.8 billion last year. Before that, 4. Before that, 5.4. These are really strong numbers. There's nothing too huge in here that would throw me off or raise flags, which I really, really like. Here's your depreciation, right? We're going to add that number back to the operating income to get EBITDA. Share-based comp, they do kick out a lot of share-based comp, $1.3, $1.4 billion. That is expensed in the P&L. So it's expensed when we look at EBITDA, but it's a non-cash item, so it's added back when you look at cash flow. After the operating income section, you've got the financing section, the middle third of the cash flow statement. Really what you want to pull out here is you want to look for capital expense. So your cash flow from investing, you want the purchase from property, plant, and equipment. $866 million. The rest of this, principal change on loan, proceeds from sales of property and equipment, change of investments, so like this $30 billion here, you're like, what do I do with that number? This is them moving their investments around inside their cash holdings. It's not actually operating cash, so I gloss over it because it's not investing money for the shareholders. It's rebucketing cash from short-term to long-term investments. It's not operating cash, if that makes sense. It's like taking money from your checking account and moving it to your savings account. You've moved it around. It shows up on here because you're moving cash, but it's not like you generated that money. It's not income. So all this is income. I ran my business. I made this cash. I have to reinvest. This is my reinvestment line outside of acquisitions. This is my reinvestment line. And then how I finance the whole thing is the bottom section. So the bottom section here is basically, did I pay dividends? Did I pay my bondholders? Did I pay my equity? Did I issue any equity? So here you've got cash flow financing, proceeds from stock issuance. It literally says right there, this is how much I'm diluting people. $130 million, that's nothing in this giant behemoth. So that's fantastic. That means they're not diluting us. Proceeds from the issue, purchase of treasury stock. That's what we want. They are buying back stock in the tune of $1.6 billion every year. That means that you buy share, you do nothing. The company itself takes its free cash flow, goes in the market, buys shares, cancels them, and the share that you own now owns a greater percentage of the business because there are fewer other competing shares out in the market. That is amazing. I love businesses that do this because you don't have to put in any more money. They make plenty of cash on their own, and they're simply buying and destroying, ripping up other shares. I love that. Some financing, which is a little bit in is out, probably very, very basic, but overall there's nothing. So it's very, very clean. I really dig that. Let's go take a look at the forecast, okay? Okay, now before we dive into the forecast, I do want to take a moment and say if you haven't visited cashflowinvestingpro.com, the website I run, please do so. You're going to find a one-pager that looks like this on there. This is a complete summary, a 10-year look at PayPal. It gives you the historical information, everything I'm going to go through today. It gives you the forecast so you can see how I derive the future forecast. And if you want to change those numbers, you're able to do so on your own. You can do that, but you see how I come up with the underlying value. And you can judge for yourself if A, the assumptions are right, and then B, if you want to buy the stock based on the return. But these are very cool. Definitely check them out on the website cashflowinvestingpro.com. Okay, let's take a look at the 9 year of history. I use 9 years on these slides, but you get 10 years on the one pager. Let's take a look and see what we got. All right, PayPal revenue, $6.7 billion in 2013, and it's continued to grow every year for the last 8 years. I'll stop at 2020 for a second, to $21 billion. When I look at 2021, remember this is December 2021, I'm filming in December, but they haven't released the annual report. So I can look at 3 quarters, 9 months of actual results and guess at that last quarter. So I'm guessing round number $25 billion of top line revenue. When I look at all of this combined on an annualized CAGR, combined annual growth rate, I get an 18% annual clip at revenue, which is fantastic. A solid, strong, double-digit number. Every single year it's moving north. That's that's excellent consistency, and it makes it a little easier for us to forecast something that's that consistent. EBITDA, remember enterprise level earnings. This is operating income plus depreciation and amortization, plus a few odds and ends if they had a legal settlement or something that is truly one-off, we'll add that back. Sometimes M&A activity, if they bought a company and they had deal fees, you'll add that back because it was a one-time deal. So $1.5 billion of EBITDA, grown pretty consistently. In fact, every year it is growing to $5.25 billion. That's my estimate for 2021. What they actually printed in 2020, 4.3. When I look at 3 quarters worth of EBITDA, kind of guess at the 4th quarter. This is a rough number that I'm getting to that holds essentially margins kind of the same over time. And what does that produce? Well, that produces an 18% annual growth rate of EBITDA. So their growth rate in revenue is translated in growth rate in EBITDA, which means margins are solid. They're not going up, they're not going down, they're just solid. All right, let's take a look at enterprise value. Again, enterprise value is not market cap. Well, in this case, it's going to be very close because they have no debt, but traditionally they do vary. We begin enterprise value with debt, short-term plus long-term debt, $9.7 billion. I'm just copying what they had in 2020. I'm not sure what this number is in 2021. I doubt they issued all that much, so I'm just going to mirror it. In fact, I mirrored cash as well, because I don't exactly know what they are, but I don't believe they're issuing too much debt, so they should be fine. But overall, the point here is overall, this is the debt schedule, and what I like is the excess cash covers the debt for most part. So they have essentially zero debt because they have so much excess cash, they can instantaneously pay off all of their debt. That's what we want to see. What's left is market cap, that's share price times outstanding shares. I add this up and I get enterprise value. Enterprise value is the true value, the true worth of the business. That's what you're buying when you buy a business. The market price is the market cap. That's the stock price you see. That moves all over the place. But the enterprise value should be much more stable because that is truly what the business is worth. And if we look at the kind of relative value metrics here, these are my multiples of enterprise value. So if I look at the enterprise value, $120 billion, and this enterprise generates $4.2 billion of earnings every year, I divide these two, and it's telling me I have a 30. That means if I buy it today, and the business doesn't grow, it will take 30 years for it to pay back. That's a long time, right? So you're expecting with this high multiple that this business will continue to grow. Future earnings will be higher than current. So this market multiple is not really 30, it's less, but nobody knows what the future holds. So we look at it kind of on a true basis, just to benchmark it. And you can see it's hovering in this, I'll call it 30 range historically. If I look at it more recently at the end of last fiscal year, actually right now rather, it's 53 times, which is a very, very high multiple. That's the 2021 assumed EBITDA against the current market cap of enterprise value $280 billion. The last one, debt, essentially zero. So that checks the box for us. Okay, let's take a look at cash flow. So here we are at cash flow, my favorite statement, obviously. Cash flow from operations, that's the first third on the cash flow statement that we talked about. That's the cash they make from running their business. $2 billion to just under $6 billion, $5.8 billion, and then I'm estimating $6.1 billion for 2021. 16% annual growth rate, that's in line with EBITDA. That means EBITDA, what's on the income statement, is translating into the cash flow statement, which is a great check on accounting. There's no funny business between what they report in earnings and what's generating cash flow. You want to check that. That's great. So that one, the CAPEX, those are the numbers that, right, they have to peel off to reinvest in their business. I'm estimating $1 billion this 2021, but here's the 866 that I showed you previously that's off their annual report. Overall, it's much less than what the cash they generate from the business every single year. So that means they generate a tremendous amount of cash running their business. They have to put back a very little bit into the reinvestment. They have no debt, so it flows all the way through to the equity holders, which is here. Here's the debt payments, very little relative to anything else, and here's the free cash flow. This is what a business is actually based on. And what this is telling you is that this business generates, well, they borrowed some money here, I'll come back. It generates $6 to $9 billion a year in free cash flow. And growing, which is a phenomenal amount of free cash. Now you can understand why, when I looked at their balance sheet, you've got the checking account overflowing with cash, and you've got short-term investments piling up because they simply cannot get rid of the money fast enough. It's piling up that quickly. Amazing. I love free cash flow. This is just so much a joy to do. Shares outstanding are declining at 1%. Now, they could do a much better job, in my opinion, of buying back shares. They already have the cash. It's sitting there. We've got inflation at 10%. If they're not yielding 10%, they're losing money. They should be buying back these shares to support the underlying equity investor, especially the recent dip that PayPal has taken might be a buying opportunity they should look into. But I take the free cash flow and the shares, divide the two, and I get a free cash flow per share. I use the current market price, and I get a yield. Now, this yield here is pretty high, 6-7%. That's high because of the debt issuance that they did recently, and you get a little positive number. I wouldn't forecast with this going forward. What I'm going to do going forward is I'll just take cash flow from operations less CAPEX, use this number, and essentially assume that this is zero. Here, I'll just zero it out so you can see what it looks like. So if that's zero, then they made $5 billion of true cash after reinvestment. Shares, that's a $4.20 free cash flow, and that's a 4% free cash flow yield if I remove the debt. Now, I leave the debt in there because that's the formula, but this is math and art. You got to blend both of them, understand what it is you're doing. The formula calls for me to add debt because, well, they have none. If they issue new debt, that is debt that can be given to the equity owners, much like refinancing your house. If you pull equity out of your house, that's true cash flow you can use. You can't do it every single year. Eventually you run out of money. But here they have no debt, so they can do that for a long time, frankly. So what I wanted to do over here, I'm just looking at what the yield is. You can barely see it. What the yield is without the debt payments. I'm going to use that going forward when I forecast. Okay, let's talk about forecasting. What I referenced before was the annual growth rate of their accounts and the total transaction value. And when I stack it up historically, 2015 active accounts in millions, it's been growing, and it's been growing a solid double digit. In fact, growth has been accelerating. Good job, PayPal. Then when I look at total payments in billions, $281 billion to $936 billion of total cash running through their system. Remember, PayPal takes a small fee. Their business models, they take a small fee off all the cash rolling through their system. So the more cash they have, the greater revenue. That's essentially what I'm looking at here. And I've got accounts growing at double digit, and I've got total payment volume growing at double digits higher than total accounts. That means the people in these accounts are using the service more and more and more. And I think that's going to continue. It's a very sticky service, and the people now will be using PayPal for 20, 40, 50 years from now. I think that's really, really true. So all I did here is I took this total value, the total dollar amount, looked at this growth rate and carried it into the future and said if they maintain the growth rate, even as it's declining over time, their total value of transactions rolling through their system is going to grow to $8.6 billion. I think that's trillion dollars, $8.6 trillion out in 2031 or 7.5 2030. And then what I do is I can take a fee off that to come up with revenue, right? Because they're just taking a rip off the money as it passes through their system. So if you can accurately forecast how much money is rolling through the system, you can project revenue. I use an EBITDA margin to come up with EBITDA. That's essentially what I did off to here. I'm just saying, here's my margin, here's my revenue, here's my EBITDA margin, here's my EBITDA. Pretty simple math, pretty basic, but based on historical patterns, data that's in the 10K, and I come up with an estimate. That's the math, right? That's the math that you use to create a forecast. We then put our hat on to judge, does it smell check, and is it worth the price? Let's go do that. All right, so behind me is essentially in the model, me plugging this EBITDA forecast in. So next year, 6.5, this is 22, December of 2022, $6.5 billion of EBITDA, growing to $36 billion. That's a monster growth rate, right? That's 5x. So on a smell check, you kind of have to say, does that foot, can they do that? Well, when you look in the past, they did 5x the last 10 years. They should be able to do something close to that in the future, maybe. It might be a little aggressive, but the whole world is going digital. These guys are at the forefront. I feel pretty confident that they'll get close to that number. What I did do as a hedge is I haircut the market multiple, right? So they're at 56 times right now earnings. That's 56 times this number. No. I'm gonna give it 20 times. That's a big cut. That's essentially more than halving the value. If I were to put 56 times here, I'd get a $2 trillion market cap for the company. But I'm not doing that because 56 is pretty nutty. And if growth rate's coming down, I'm not gonna give it that. So I'll give it 20x to be conservative. That's a $725 million market cap, which by the way is a huge change. 56, $2 trillion market cap, share price gives me $1,700 a share. I'm gonna give the 20x, leave it there, less some debt plus some cash, $725 billion market cap. Shares outstanding, 1.8 million, gives me a forecast price of $611. That's the forecast that I'm using in this model. You can see if they can maintain this target, then if they maintain a 50x, it's much, much higher. If it comes down, I'm conservative. If they miss this growth a little bit, but market multiple stays up, maybe it bounces out. It's all a guess, but you see the logic. Cash flow per share. So the same thing here. Free cash flow from operations, less CAPEX, growing at the rate that I was growing EBITDA. I get this to here, $20.31. I apply a free cash flow yield of 3.5% based on what I looked at historically. And I get a $660 price target out in 2031. All right, I'm going to pause here for a moment and remind you about the Cash Flow Investing Pro website. If you want to learn how to do this, running financial models like this for yourself, right? But there are more than 3,000 stocks just in the US. There are many more worldwide. Nobody can cover all of them. And there are a lot of stocks out there that are not covered by analysts. And making an assumption like this is not difficult. Everybody is wrong. Professional analysts are right only 50% of the time. So really, if you have an expertise in your field, you might be very good at judging the competition in that field. And go to my website, go to the Cash Flow Investing course, take it. It's $300. It's 3 hours of content, gives you this Excel model, gives you 10Ks, teaches you how to run through and evaluate, and how to build a forecast. And you can make these decisions for yourself, and with practice, you'll get very good at it. All right, so let's keep going. We have two price estimates for PayPal. I've got $660 and $611. I'll average those to $635. Again, behind me is simple math. Who knows what the future is, but at least we have a target based on some rational thinking of where we believe the stock should be in 10 years. Now we have an opinion. I look into the market and I say, oh, I can buy as much stock as I want at $188 a share. I plug this into a simple IRR calculation. Free cash flow. I buy as much stock as I want, in this case, one share, $188 a share. I sell it, hypothetically, in 10 years for $635. Over that time frame, I have invested in a business that produces a stream of cash flow, such as this, that they can dividend out or they can use to buy back shares. Either way, I get the benefit. In the end, that is a 19% IRR investment over that period of time, which is strongly, almost doubling what the S&P 500 has done historically. One might argue that the S&P 500 is not going to do what it has historically because it has such a monster run-up. The other thing I like about this is, that's 4 times your money. The other thing I like about transactional-based companies is as inflation happens, as they print more money, right? There's more money in circulation. These guys are getting a fee off that money. So when you think about how inflation affects businesses, these guys don't have to raise pricing, right? Because that money that's printed and pushed in the economy is moving through. So they are getting a rip off all the cash. What I like about transaction-based companies such as PayPal is if there's inflation like we're having now through money printing and there's greater money in the economy, PayPal doesn't have to raise pricing like a retail business would have to raise pricing. These guys simply take a fee off of all the money that's moving through their system. So if there's more money that's printed and pushed into the economy, then that's more money that's floating through their system. They have the same payment on a greater dollar amount flowing through the system. Their revenue, their earnings go up. So I think that's naturally going to rise with inflation, and that's why I like that purchasing power protection. All right, so here's our distribution of return. $888 the current stock price, 19% IRR based on the assumptions we have here, which are purely assumptions. If I raise the stock price based on the same assumptions, my return goes down. I'm still a buyer here. It's still a decent return, but if it falls again, like it has recently, I'm a huge buyer. I like this stock. So let's recap our 5 key attributes. 1, top line revenue growth. Absolutely, it's growing. Number 2, EBITDA, earnings growth, it's growing. Number 3, strong free cash flow, absolutely. Number 4, no debt, 0 debt, awesome. And number 5, well priced. Yes, it is very well priced. Even at the high price multiple it's trading at, the future cash flows, I think, are very bright here. And this almost doubling of the S&P 500 expected return means it should outperform the stock market. So we're going to give it a good at this channel. I like this stock. I like the management team. I like what they're going. So, as a recap, check out cashflowinvestingpro.com, the website. Get yourself a one-pager like this. Sign up for the Cash Flow Club. I produce these as often as I can. I'm cranking them out. The more people that sign up, the greater the team I can assemble. I really would like to expand this program and do all the stocks in the S&P 500, but I need more members to do that. So hang on for me for a little bit longer. Keep signing up. You guys are doing great. And we will build an infrastructure that produces these for everyone. I will make it as economically affordable as I possibly can, but I need the cash now to build the infrastructure to do so. So please check that out. If you want to learn how to do forecasting like this and be an analyst for yourself, I highly, highly recommend it. It will serve you for the rest of your life to be able to read a 10K, pull out the salient points, put it into Excel model, think about the future, lay it out, and then revisit it every year, and that will change how your portfolio runs. You don't need to speculate. You don't need to be chained to a desk, day trading, risking a lot. Go live your life. Let others work your money for you. Just pick the right horse. Awesome. Thank you very much for the time on the channel, on the comments. Don't forget to hit the subscribe button. If there's a bell, do a bell, whatever. I don't know how that works, but just hit the subscribe button. Follow me on Twitter, and thank you very much for the time. Really, really appreciate it. I hope you like PayPal. Very, very interesting company. My name is Cameron Stewart, CFA. Thanks so much for the time. Take care. Bye-bye.